Welcome to Central Bank Central. I'm Kathleen Hays. So, a very big inflation report released today. Interesting how the media, which I am part, portrays it. An interesting headline. Core CPI, that's the inflation report, the consumer price index minus food and energy, rises as expected, keeping the Fed on track for a rate cut. But this is the place the Fed is at now, and this report, while it didn't have any surprises, it certainly underscored that inflation and rising inflation right now is not what's driving the Fed, but certainly a look at the labor market and other factors are. So I'm very happy to welcome back after a report like this Marvin Barth. He is the founder and author of Thematic Markets. He worked in his career at the Federal Reserve, at the US Treasury, the BIS, the Bank of International Settlements. So he's worked among central bankers and policymakers for a long, long time, including his time working in financial markets. So, first of all, welcome back, Marvin. Great to see you.
Thank you for having me, Kathleen. It's great to be here.
And at some point, when you give me an answer, I'll say, seriously, Marvin? That's the name of his podcast on
Yes, you,
Substack.
you sound like my stepdaughter. She makes fun of that name all the time.
So, in terms of this report, we spoke a couple months ago about a couple of reports ago.
Yeah.
Inflation's rising, it's going to keep rising, you were concerned. And what we see again, as I said, we've got the core consumer price index, takes out food and energy at 0.3% in July, the overall CPI up 0.4, and the year-over-year rates for the main numbers are still rising. So let's start there. What is the main message from this report for you?
Well, I think that the message I take away is very much in line with what I sort of inferred implicitly from your review of the way the media was covering it, which is a little bit of an astonishment that really we've got inflation running well above 3% and accelerating on a core basis, right? And the reason why you focus on core, obviously, is that food and energy prices can be very volatile, but they don't tend to be persistent. Stripping out those leaves you with a much better view of where the trend of inflation is. So the fact that core inflation is accelerating now over 3.5%, I think is quite troubling. In fact, if you look at the just month-on-month changes over the course of this year so far, we've had three 0.3% month-on-month changes out of the 8 months so far this year. 6 of the 8 have been 0.2 or greater on a month-on-month basis. That is all consistent with inflation well above the Fed's target. So for markets to get excited that somehow it happened to match their expectations, or think that this puts the Fed on track for interest rate cuts, certainly given the background of what we're seeing in the economy, I think is a little bit misplaced. Although I'm only going to say a little bit misplaced because the Fed has frankly been leading us in the direction of thinking that they are going to focus more on employment, as you mentioned.
But a lot of it's tariffs, and we don't know how much they're going to get passed through, probably more, but they're not going to last forever. So you can kind of put that to one side and then look at other things like the labor market. But let's look at the tariffs. What do you see when you look at this inflation report and what tariffs are doing?
Yeah, I think this is an important one, and it's interesting to me that I actually continue to hear people discount the idea that tariffs are affecting inflation. But if you look at the sort of trend in core goods prices and core services prices, there's been a complete flip-flop in those two over the last 6 months. So if you go to last year, core goods prices were experiencing deflation. They were actually falling as they had the previous year. And what had been really driving inflation and everyone was focused on was core services, particularly housing price inflation. Now, I think there's two really important points here to be made. The first is that obviously we've seen a relative price shift. That is, the relative price of goods has gone up versus the price of services. that is absolutely a real price shock that is associated with tariffs. I think it's very straightforward to see that shift take place, and it's perfectly coincident with tariffs when we haven't seen a shift like that in years makes it pretty clear. But the second point that I think people miss a lot is this point about the difference between relative prices and general prices, right?
Okay.
And this is crucial to the way I look at inflation. So we talked about before core prices and why you would want to strip out food and energy. Remember,
Mhm.
food and energy, they're important to people's cost of living. That's not why we're stripping them out. But the point is that people don't change their consumption of food or energy because the prices rise or fall, right?
Right.
They're
Right.
very those are things that there are in what economists say are highly inelastic. And so that's why their price inflation tends to be less persistent in there. And so that's one of the reasons why we strip them out. But you don't want to go beyond that because what happens is you start to focus on relative prices rather than the actual trend of overall prices. Prices
Okay.
of individual things are moving up and down all the time within the CPI
Yeah.
basket, right? And but
Hmm.
what inflation is how the whole basket moves. And what we see in this flip in the rates of inflation or acceleration rates of inflation between core goods and core services is that the fact that overall inflation is still trending higher, i.e., we've started to re-accelerate, is telling you it's not about one or the other. It is about something else, which is about beliefs.
Expectations, you're saying, beliefs of where
Yes,
it's going to go.
exactly.
And of course, you you note in a note you put out for me that this is something you're watching very closely. But it's interesting too because it seems to me that anybody who is on, if we're looking at the Federal Reserve and we're looking at the Federal Open Market Committee, and we're looking at regional bank presidents, and we're looking at governors. We have some governors like Chris Waller, who may be in line to be the next Fed chair. Um, very adamant this is time to cut, and he's looking a lot at the labor market, etc. But then you have people like he's not alone, but Mr. Muslim from the St. Louis Fed and others saying look at inflation expectations. And in particular, even though a lot of people sort of downplay the University of Michigan survey, and which has showed a steady rise in inflation expectations, most of them will at least say, yeah, that does seem to be pointing that way. And when you hear Muslim focused on it, you think, well, does that mean he, when the vote comes next week at that Fed meeting, is he one who's going to maybe want to hold back and maybe not jump on yet? Although the drum's beating so loudly at the Fed, I'm just wondering, can anybody not go ahead and say, okay, well, at least do one 25 basis point cut?
Yeah. Well, I mean, there's a whole nother sort of issue about how Fed members have to vote in the current political environment. We might want to
And
come
we'll
back
get
to
to
that
that.
point.
Yes.
But I think to your fundamental point, like, look, you know, one of the reasons why I was so adamant that inflation was going to take off back in 2020 and 2021 was that it was very clear that inflation expectations were taking off. And I think it's important to note that I was not one of those stopwatches who was always saying that. I actually expected the fall in overall inflation that we had in the previous decade, despite all the QE then. So it really was about focusing on expectations. Expectations are really critical. And that's why I made that point about the relative prices versus general prices. We it is the general prices are being driven by people's expectations. And to exactly your point about the University of Michigan survey, you know, it's come off a little bit in the last 2 months, but we are still at levels that would be higher than anything we've seen in 2 to 3 decades. Now, that should scare the heck out of you if your mandate is to contain inflation to what you've self-described as 2%. The other thing that I think should scare people is if you go back to what happened in 2020 and 2021, The New York Fed survey of inflation expectations, I really prefer that one. It doesn't have as long a time series history,
Yeah.
but it breaks it down by demographic groups really well. And one of the things you see is that the people closest to prices, the people who are most affected by any rise in inflation, those with lower educations and those with lower incomes, were the ones who moved first. You could see the rise in inflation
Mhm.
expectations coming from them. Now,
Yeah.
the reason why that's important at this point is that that group of voters or consumers we know as voters largely favor Donald Trump. And a really interesting thing happened to their inflation expectations over the last 8 to 12 months is that they absolutely collapsed once he was elected president. They really believed this
Yeah.
guy is going to solve their inflation problem for them. And then the Epstein files hit. And I kid you not, in 1 month, they go right back to where they were. So
Wow.
if I were a Fed official, I'd be very scared about that because these guys were a leading indicator in 2020 and 2021, and they're coming back again.
Well, okay. And in fact, services prices are tending to rise again. Is that
Yep.
right? And that's the biggest part of the economy and the biggest. So what do you attribute that? Because I want to my next question is the labor market, right? And the fact that
Yeah.
jobs have been weaker and they're not growing as much. But one of the things, if I could almost put this in two parts, services jobs are, well, many of them are filled by people who have been immigrants, who might
Mhm.
be new immigrants, right? When you look at hospitality, when you look at other kinds of things. And that does that kind of tie together? Are services prices rising as the people who would fill services jobs are scarcer? And does that kind of put those two questions together around that? Immigrants, what are they doing? The lack of immigrants, deportations, what is that doing to prices, number one, and jobs, number two?
Yeah. So look, I said earlier that I think that on a broader basis, the economy seems to be doing very well, contrary to the narrative that's taken hold since the two most recent employment reports. And there's a good reason why people focus on the employment reports. I know when I was at the Fed, it was a common view among Fed economists that if you only had one piece of data to follow, it would be the non-farm payrolls, right? That,
Yeah.
it's generally one of the better quality pieces of data that we have. And it is quite broad and it tells you a lot about what's going on. It may be a bit lagging, but it's a good indicator overall. And yet, I think that can be very misleading because literally every other piece of data I'm looking at is telling me that the US economy is accelerating quite rapidly right now and was on very firm footing to begin with. So then the question is, why did inflation or why have we seen these massive downward revisions to employment and pretty weak job growth recently? And I think you hit upon exactly the point there, Kathleen, that we've had a massive exodus of foreign-born workers in the United States. So, the establishment survey doesn't tell us where workers come from, but the household survey does ask questions. Were you born in the United States or were you not?
Okay.
What we see there is that since it peaked in March, foreign-born employment has dropped by about 1.5 million people, right? Um, and oh, by the way, native-born workers have increased by a little bit less than 1.5 million. So that's kind of that's why you see it's a bit weaker. But
Okay.
exactly to your point, there is a clear exodus of foreign-born workers, and there is a large share of them that do work in services and are obviously going to have a significant impact on the overall job numbers. So I think that's one really important potential explanation for this. There are two others that I think we can't discount. One is it's related to it somewhat, which is that we have a skills mismatch, right?
Okay. Okay.
So, one of the things that has happened over our lifetime, Kathleen, is that everybody's been told to go to university. Everybody's been told you have to go to university. It's the only way ahead
Right.
in life. And, you know, we now have 40 to 50% of the young population of the United States has a university education. And the question is, do we have 40 to 50% of our jobs that require those? Or um, is it the case that the manufacturing industry, which is screaming bloody murder, that they can't find any electricians, they can't find any welders, they can't find, and oh, by the way, all those jobs pay more than
Yeah.
most college university jobs.
Yeah.
They pay significantly more.
Hmm.
Um, and
And you
so I
can't ship them overseas. If you're,
exactly,
you get a plumber in, if you're an electrician, they have to physically be in the US. They cannot be in a call center in India. They cannot be in
yes.
a very sophisticated, sort of tech services firm in India and compete with your job.
Well, not only that, but it's even double that problem now, right? Because now we have, you know, and this is not just a Trump thing, right? You know, the Biden administration was pursuing industrial policies to try and bring back manufacturing through subsidies. Trump's trying to do it through tariffs. But the key point is they're trying to actually create more manufacturing jobs that require these types of skills. And we simply just don't have the workers.
Right. Okay. So that's part of the skills mismatch.
So the skills mismatch may be part of the problem. And then the third one is we may actually be seeing the first signs that AI and automation really are taking human jobs.
Yeah.
I don't have good evidence on that, and I'm not sure that's even the strongest candidate, but it's one we can't discount.
Okay, so I want to keep popping around on these different topics, but in terms of the Federal Reserve, um, so you've touched on the fact, and the Fed knows this, right? I mean, when I was out at Jackson Hole, Kansas City Fed Symposium, I spoke to Stephen Davis, Stanford University, Hoover Institution, known for many areas of applying economics to real life. But labor market is one of his big ones, and he thinks the natural rate of employment growth could be as low as 50 to 60,000 a month now because of all
Yeah.
this. And some people say, yeah, it could be even lower. So does it make sense then for the Fed to still say, well, okay, it isn't really the labor market showing us we're going to recession or anything like that, but the policy is still restrictive. And when we look at R star, the neutral rate, it's it's got to be way, way different. And the Fed funds rate, the Fed's key is way too high relative to that. And that seems to be one of the big legs the Fed is standing on right now.
Yeah, I think that's absolute ridiculousness. Sorry. I mean, basic economic theory is that the neutral interest rate is related to the marginal product of capital. If you're telling me that you either have a constrained labor force because of immigration or because of a skills mismatch, or even worse, because you can now substitute capital for labor, all of those things mean that the marginal product of capital, i.e., the value of investing another dollar in an piece of equipment that replaces a worker, is worth a heck of a lot more, right? And so that means all of that, all of those things, any explanation we want is telling you that R star is actually a lot higher. And in fact, while the data haven't been revised yet, on the output and productivity side. But the clear point of these massive revisions to labor suggest that actually measured productivity is a lot faster than we thought. So all of that says that the neutral interest rate is actually much higher. Now, that doesn't solve your employment problem because really the Fed's mandate is stable prices in an environment of full employment, right? And so let's say it is that third option I suggested, that it's AI and automation taking everybody's
Okay.
jobs. Now, you may want to say, and I've been thinking about this conversation I had with Philip Lowe, who was an old colleague of mine at the BIS, who was later governor of the Reserve Bank of Australia.
Yeah.
Um, uh, and this is during the lowflation period of the last decade. And he was saying, look, the lesson we've learned is that we just have to run the economy a lot higher to get inflation back up. Well, you
Wow.
could make the same argument about we have to run the economy a lot harder to get employment up even if R star has actually risen, you still might want to cut rates to drive that. That might be an argument, but then you have an inflation problem on the other side that you're not dealing with.
Well, yeah, and I wonder, I've there's more people I've seen comments here or analyses where, oh, it looks like implicitly the Fed is just saying, okay, right now our target is 3%, and that's fine. And the bond market seems to be saying, yeah, that's fine. Okay, that's fine. And I just, if that's where the Fed is now, does that have, if they cut rates now, is it like, well, don't worry about it, there's all these, is it a mistake? Is it a mistake to cut rates now? Is it dangerous? Or can we say, okay, so they'll cut, we don't know how much they'll cut, we're uncertain about our star, there's two, debates on either side of that. What's the outcome of that? Is that fine, don't worry about it? Or is there some down the road, what does it mean?
So, um, you know, we probably still need to have that discussion about the personal motivations of individual FOMC members. But in terms of the implication of them uh, cutting, which I would say is inappropriate at this stage, then what that means is that we are going to see inflation continue to accelerate. And the reason for that is very, very clear, is that whether it was labor acting as the capacity constraint or capital equipment and your ability to build more capital rapidly enough, the economy is still running above its potential growth rate, according to the Fed. Inflation is well above target, has been well above target for 4.5 years, going on 5 years. And inflation expectations are solidly above your target. And if you tell people that your new inflation target is higher, guess what their reaction is going to be? They're going to say, "Oh, well, they've done this once; they could do it again." Right? And it's just going to run away. So I am, I think, actually, I have to say, I'm quite shocked and perplexed that the bond market has been as acquiescent to this as possible. I don't know what happened to all the bond market vigilantes. They seem to have moved to France, somewhat appropriately in some sense, but forgotten about the US. Um, and so I do think that that's a real concern. Um,
Well, it's interesting, isn't it, that the Fed revised it had its framework review. Jay Powell, also out there in Jackson Hole, talked about it. It's interesting when he talked about getting rid of flexible average inflation target, and he said it was sort of irrelevant. Now that was an interesting comment from him.
is that because the 10-year average inflation rate is above their target?
Perhaps, but also I think it's interesting that here we are, and in fact, I just have to throw in one comment. Someone I won't quote by name said that they thought that this framework review was kind of a disappointment, that it was like someone did a wordsmith version of the 2020 review or the 2012 review, and just put it out. But apart from that, the Fed's adopted a new framework, supposed to be more inflation. You can really raise rates if you're seeing inflation going up and getting out of control. Maybe, but they don't see it out of control. I guess that's it. Do those things jibe, or does it have, see, I don't think it's the White House pressure. I think there's enough people on the Fed who really think that, yes, it's time to cut. The labor market is weakened and they're concerned about that. But that's certainly a big question hanging over them right now. And what do you see there? Because you kind of touched on it just now, but do you think there is some feeling of, hey, we can go ahead and do this. It's not going to end the world. Let's just do a couple rate cuts and get them off our back.
Yeah, look, to your first point, the framework review was, I think, quite disappointing. And I think that Secretary Bessent's very overt calling out of them for a complete serious outside bipartisan review, it was absolutely appropriate.
And
The
you're
Fed,
talking about the piece last week where he
yes,
wrote international economy and said what is gain of function monetary
the
policy, and
gain
said
of
that
function.
yeah, he's
He
not saying you have to
likened
bash.
it to COVID, which I
Yeah,
thought
yeah. Yeah.
And I think, within the world of finance, it is appropriate, right? This is a big, serious failure by a central bank. As you know, have been very critical of this central bank. This is one of the worst inflation failures we've had in the 112-year history of the Federal Reserve. They should be called out for it. But to your point on, or question rather, on, how do I see them playing out? You're absolutely right. They have had this too low view of R star throughout this, and they have been always at every single turn, as soon as inflation gave any indication whatsoever that it might be going their direction, immediately leaping on with, dovish rhetoric or even cuts. And I think they've been proven wrong each time. Inflation has reaccelerated immediately after that. And they still haven't learned. So I agree that in general, this committee just has a flawed view of the economy, of R star, and of what's driving inflation. But I do think, look, and I've come across in a lot of my writing, I'm not affiliated with the Trump campaign. I'm not, a part of MAGA or whatever, but I come across a lot in my writing as being very supportive of Trump's policies overall, because I do tend to see them working out better than most people think. That said, I was very uncomfortable about the sum of the pressure, not his criticizing the Fed. I actually think is everybody has a right to criticize the Fed, including the president. That's not inappropriate. But when you start trying to take people out with criminal charges, like,
Yeah.
look, on one hand, let's just suppose that the alleged charges against Lisa Cook are correct. If they
Back
were,
up to
then
Lisa
that
Cook,
is
yes.
then it is appropriate that someone from her should be removed from that position, because what she did is inappropriate. But that should have been done by the chairman of the Federal Reserve, not by the president of the United States. But what bothers me about this is that in the current politically charged environment, I don't care who you are on the FOMC. Applies to the president of the reserve banks as well. You have to start thinking, well, what could they find about me? If this really is a politically motivated thing, which you don't know for sure, maybe you should change your perspective on this. So I do think it's hard to discount that in the back of their mind, they're all thinking, better do what the guy says.
Well, so so what do you think, a real kind of basic Fed watching question, if this is a Fed that is looking past uh, other views of our star? They say, no, 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 Marvin's wrong, those guys are wrong. It's the policy is still restrictive. I will say that okay, if they're on this path, and that's the majority, and even if some of the consensus is on the weaker side at the FOMC, but they're going to go ahead and support the chair, for example, they're going to support
Yeah.
Powell, then how
Yeah.
many cuts are coming? Are they going to cut on Thursday, excuse me, Wednesday next week? Is it possible they'll do a 50 basis point cut, that kind of thing? And will the cuts keep going?
So I think that my call earlier before these last two employment reports was that they wouldn't cut at all this year. That the strength of the economy and the reacceleration of inflation, which did happen, would prevent them from doing so. Because to be fair to them, despite their biases, they actually have done that multiple times, right? They've said, well, yeah, we're going to start cutting, and then they pulled back when they saw the data. I think the employment stuff, and potentially in the background, this issue of the pressure tips the scales, and they're going to go ahead and cut. So I expect they will cut next week, particularly because Chairman Powell has said effectively that they will. I don't think it's going to be 50 though, because I do think these points about whether markets think that inflation was on expectations or not, it's still way too high. Inflation expectations, to exactly your point, there are lots of members of the committee that are very uncomfortable with where inflation expectations are. And if you are going to be a responsible policymaker, and ultimately I'd like to believe that all of them, despite my difference in views with them on what's going on, are responsible, trying to be responsible policymakers, you have to look at what I said about what are the explanations for why employment could be weak relative to these other things. And if you're in this view that it could be just an immigration shock or a skills mismatch, then you have to recognize that that is not a negative thing for most people in an employment market. The unemployment rate is going to stay low, and this is going to put upward pressure on inflation, if anything. And so that uncertainty you have over whether it's related to something else should hold you back from moving too quickly. And I think the data are going to come out over the course of the next 6-12 months in such that the economy is going to do well. The unemployment rate isn't going to go up, and inflation is going to be above their target, and that's going to hold them back. So I don't think that, despite what markets have are pricing now, I don't think those expectations of markets are going to be fulfilled.
Okay, well, it'd be a kind of a repeat of about almost a year ago, right?
Yes.
When they cut and they cut right before the election and all that, and then the next thing they knew, inflation was rising again, and they had to pull back. Well, Marvin Barth, thank you so very much. Great to see you.
Thank you. I really enjoyed this. Thank you.
Okay, Marvin Barth, Thematic Markets. Seriously, Marvin, that's where you can see him on Substack. I'm Kathleen Hays, and this is Central Bank Central.